Welcome. We're going to begin to look at performance evaluation and also the balanced scorecard. Now this is a topic that's really relevant to all of you because when you go to work, whether it be a for-profit company or a not-for-profit company, education, you will be evaluated, and we're going to look at some of the tools that companies use to do this. Before we begin, it is important that you understand what we mean by a decentralized organization. And in a decentralized organization, decision-making occurs at all levels of management. So you have your lower level managers given authority to make some decisions. Now companies are not just decentralized or centralized, it falls along a continuum. Now, as a company becomes more decentralized, it is more important to have a good performance evaluation system. You're going to have lower level managers making decisions. You want to have a basis for evaluating those decisions. Right, there are some clear advantages to decentralization. One being managers with first-hand knowledge are making decisions. You have the production manager making production decisions. You have sales managers determining which product lines to carry. And so these managers know what goes on in their segment. It also provides management training. If you will have people making decisions at lower levels as they get promoted, you're just adding to their responsibilities. It will also free upper management to focus on more strategic, long-term decisions and not the day-to-day decisions that need to be made. And it's a motivation tool for managers. If they're given responsibility, then they're going to try to meet those goals. And it allows for faster response to change. The disadvantages: it can lead to duplication of assets and services. You may have to have more than one accounting department if you're very decentralized, or more than one HR department or IT department. And so this does cost money. Goal congruence can be an issue. We're going to talk about this just a little bit more as we talk about the tools, but what we mean there is managers' goals aligning with corporate goals. And it can lead to lack of coordination. If every manager is trying to look out for their own segment, then they may not coordinate well with the other segments of the business. We'll be looking at a responsibility accounting system. So first you need to understand what that is. It sounds like we're going to talk about ethics, being responsible accountants, but actually it's a system where you accumulate and report costs and revenues based on the manager who has the authority to make those day-to-day decisions. So a responsibility accounting system is used in performance evaluation. You'll break your organization into subunits, and they have specified activities that they're responsible for. Then you'll prepare a report for each of these segments that's used to evaluate performance. Now this is not difficult to do because typically as a company grows, they will departmentalize. You'll have a purchasing department, and you'll have a production department, and you'll have a sales department and a marketing department. And we just departmentalize as we grow just to keep the organization organized. All right, when you're evaluating managers, it is important to identify what type of responsibility center that you are looking at. So a cost center, here the manager can influence only costs of their segment. Examples of this would be production manager, your accounting department manager, HR department manager, or IT department managers. So you can see these are low-level managers. They deal with production, or they deal with service to the rest of the organization, like accounting, HR, and IT. Profit centers. This manager can influence both revenues and costs of their segment. So, in other words, they can influence the profit, revenues, and costs. Examples might be a sales department manager or a division manager. And the last of the three types of responsibility centers that we'll look at is investment centers. Here, the manager can influence revenues, cost, and the allocation of resources. So this manager gets to decide how to use the assets of the company, which product lines or other departments to invest them in. So I have division manager or CEO. So you saw division manager could be a profit center, could be an investment center, and it really depends on the level of decentralization. If it's very decentralized, division managers could be investment centers, making decisions as if they're running their own business. And CEO, of course, the manager at the top is going to be an investment center. So if you think about the CEO of PepsiCo, this manager has to decide how to use the assets and allocate them among the three major divisions: soft drink sales, Frito-Lay, and Tropicana. And of course, this will change from year to year, this allocation of resources, depending on how the manager thinks each of these divisions is going to perform. So now that we've defined what the responsibility centers are, let's take a look at how you evaluate each of those three types. So in performance evaluation, you want to use these responsibility accounting performance reports, which compare actual results to the budget. So we've talked about budgeting, but do understand that we're going to compare the actual results to the flexible budget for performance evaluation. So how do you evaluate a cost center manager? Well, here you will compare flexible budget costs to actual costs. We'll see a problem later in the chapter to see how to do that. For now, just know that you would compare flexible budget costs to actual costs. For a profit center, you'll compare the flexible budget profits to actual profits. So you'll have both revenues and costs in this report, and we've actually already prepared one of these in a prior chapter. So go back and look in your flexible budgeting chapter, and the first example we worked on flexible budgets was called Samaritan Medical Clinic. If you look at that, that is an example of a profit center performance report. So the focus of this chapter will be evaluating investment centers, because we have not seen that in prior chapters. So here we want to evaluate these managers based on income, but we want to consider the investment available. So understand that if you have two divisions and each of them has $200,000 in income for the year, but one had $200,000 in assets and the other had $400,000 in assets, then you understand that the one that has the lower level of assets yet the same income is actually performing better. Now we're going to look at some detail on how to evaluate investment centers in the next section of our notes. So turn with me there. How do we evaluate investment centers? Well, we've got a couple of tools that we use. One is called return on investment. You'll see this abbreviated ROI, and it's a pretty simple calculation. Net operating income of the segment divided by the average operating assets of the segment. Return on investment. Another word for return in accounting is income, and the investment is the assets that are given to the segment. All right, note that average operating assets are beginning assets plus ending assets divided by 2. Normally in this chapter that number is just given to you, but that's how it's computed. Now also note that each company would have to define their operating assets. They could use the gross value, the net value on the books, historical cost. There's a lot of different ways to value the assets. The key is to be consistent across all of your investment centers. All right, so return on investment is income over average assets, but DuPont developed a model that provides more detail for manager some years ago, and they said that ROI is actually profit margin times asset turnover. And profit margin is net operating income divided by sales, the percentage of sales that goes toward income. Asset turnover is sales divided by average operating assets. So you can see that this ultimately comes out to be net operating income divided by average operating assets. Regal Company reports the following data for last year's operations. Net operating income, $30,000. Sales, $500,000. Average operating assets, $200,000. Minimum required return on investment, 12%. So companies will set a minimum return that they expect each year, and for this company that is 12%. So if we want to make the calculations, ROI in its simplest form would be the net operating income given to be $30,000 divided by the average operating assets of $200,000. We can see that the ROI was 15%. But if we want to look in greater detail, we can take net operating income divided by sales, that would be our profit margin, times sales over average operating assets of $200,000. So the profit margin is 6%, and the asset turnover is 2.5. This will give us a 15% ROI. So notice that you do get the same answer if you use the abbreviated format of return or income over assets or profit margin times asset turnover. Either way, other than rounding, you'll get 15%. Now, how do we evaluate this manager? Well, this is good because the actual ROI of 15% exceeds the minimum ROI of 12%. So for ROI, you compare the actual ROI to the minimum desired ROI. How can we increase ROI? If you're a manager and you're trying to increase this, the three ways are to increase sales or decrease costs, or finally decrease assets. So let's think about why this works. The first two, increase sales or decrease costs, increase your income, which is your numerator. So you can generate more sales or control your costs to increase your ROI. Now, decrease assets, what this does effectively is decrease your denominator, so you can make choices to reduce inventories, and that will increase your ROI by decreasing your assets. Or you could sell off some assets that you don't need. So managers will keep this in mind and make decisions that will increase their ROI, since this will be used for performance evaluation. Advantages of ROI? Well, the primary advantage is that it encourages managers to focus on generating sales and controlling costs. In other words, it does what it sets out to do. Encourages managers to maximize income. Encourages managers to focus on generating sales and controlling costs. The disadvantage, the primary disadvantage, is goal congruence. Managers may make decisions that benefit their division but don't align with the company goals. So they may cut corners that reduces the quality of the product That will reduce their cost and increase their ROI, but it may damage the reputation of the company. That's an example of goal congruence issues. All right, the second technique that we're going to study is called residual income. And this is the income that's left over after you earn the minimum rate of return on assets. Residual income is the income that's left over, the residual. The formula: you'll take your net operating income for the division and you'll subtract an investment charge. This investment charge is computed as minimum desired ROI times average operating assets. Now, this investment charge that's computed, minimum ROI times assets, is not a real charge charged to each division. It is actually just charged against them on paper to find out if they have any income left over after they pay this investment charge. That income left over is called residual income. So that's our formula for residual income. Before we work a problem, we need to make sure we understand the interpretation. Once you calculate the residual income, you will get a positive number, 0, or a negative number. If it's a positive number, the division is earning greater than the minimum ROI. So that will result in a good performance evaluation. If it's 0, the division is earning a return equal to the minimum ROI. And that would still be okay. They are at least earning the minimum. But if it's a negative number, if residual income comes out to be a negative number, the division is earning less than the minimum ROI, and this would be an unfavorable evaluation. What is the residual income for the Southeast Division of Regal Company from the prior page? So let me remind you of what you saw in that example. Regal Company reports the following data for last year's operations. Net operating income, $30,000, sales, $500,000, average operating assets, $200,000, minimum required ROI, 12%. So to get residual income, we're going to take the income of $30,000 and subtract an investment charge. So we'll start with that net operating income of $30,000, and the investment charge is based on the minimum ROI. The calculation is the minimum ROI of 12% times the assets of $200,000, or $24,000. So this division is charged on paper $24,000 for using the company's assets. The residual income is $6,000. This is a positive number, so what this means is that the division is earning greater than a 12% return. It's earning greater than the minimum requirement. The advantages of residual income: well, first, it also encourages managers to generate sales and control costs. That's the goal of these performance measures. So it achieves its goal. But this particular measure overcomes some of the goal congruence issues. Now, we'll work an example later that kind of demonstrates this point, and it's really why the residual income model was developed. Disadvantages of residual income: well, some goal congruence issues remain. The bottom line is anytime you evaluate employees, you're going to have behavioral issues, and that will cause there to be differences in personal goals versus corporate goals. It also gives favor to larger investment centers just because of the relative nature of the calculations. And we'll see a little bit of this in our later example as well. There is another tool called economic value added. It's very much like the residual income calculation, but it really focuses on the outside investors and long-term creditors perspective. So we're not going to really cover that, but do know that this is another way that a company can be evaluated. So I'll see you in class, and we'll work some details out on this. You kind of just got the basics, the formulas, definitions, advantages, disadvantages of our evaluation techniques, but we'll demonstrate some more complicated situations in class. So I'll see you then.